we can't forget the focus of this class is on the financial statements, the balance sheet and the income statement and statement of cash flows, and not necessarily what the IRS cares, although it interweaves into the financial statements. So when you're dealing with income taxes, we know that the IRS rules are complicated. And they have a different motive and different objective than the SEC or FASB rules. So when we're trying to account for the taxes, we're reconciling these differences. So when we have an issue where there's a taxing difference between book and IRS taxable income, we've got to reconcile the two, and we do that by first, I think, just outlining what is what we call the pre-tax accounting income. And the problem tells us right up here it's $70 million. And then we would also want to know what is the taxable income. And they don't tell us that. And what you need to remember is the pre-tax accounting income is more of a FASB term, a GAAP term, and the taxable income is an IRS term. So what they do tell us is, these things would equal, the two would equal if we didn't have any differences between the tax laws and the GAAP rules, but we've got one issue that arises, and that's this difference in depreciation. And the tax rules do allow this Maker's method for depreciation. It stands for Modified Accelerated Cost Recovery System. And what it does, in essence, is allows the company to depreciate the asset for tax purposes at a quicker pace. So up front, they depreciate more, and you can see that with the schedule that we're given in the problem here. Maybe it was put into year halfway through the year, which is why that first year isn't larger than the second year, but it trails off eventually, so it's smaller, but we're still going to depreciate $600 million worth of value from the depreciable asset using the tax method. And for GAAP purposes, remember our goal is profit that's accurate, and so we would like to think that we don't want these spikes and valleys in profit as a result of some crazy tax rule. So we say depreciation makes more sense, depending on the asset class, using a straight line approach. So it's nice and even over these 4 years, and it's still going to match the $600 million. So when we look at the first year, we have a difference that has arisen as a result of the depreciation by $48 million more. The tax depreciation was $48 million higher than the book depreciation. And so what that means is this $70 million of pre-tax or FASB income is larger than the tax income, because for tax purposes we get to deduct an additional $48 million in depreciation. So we're going to take that $70 million and subtract 48. So we're going to calculate our taxes, which we have an enacted tax rate of 40%. So at the end of this first year, we're going to have income tax expense, which is a GAAP number of 40% of the pre-tax accounting income. And the IRS number, we're going to have to pay the IRS. Income taxes payable, a liability increases with a credit. We're going to pay them not $28 million, because they say using our rules you only have to pay 40% of your taxable income. So $8.8 million. Now we've got a difference between the $28 million and the $8.8 million, and that's what this whole chapter is investigating. What is the difference, and how does it work, and why is it there? And at this point we would say we have a deferred tax liability. And the reason that is the case is because we were able to deduct the expenses up front, and what that's going to do is reverse itself over time, where we're going to have a larger tax bill as a result of lower depreciation in future years. So I just created this T account for to keep track of the deferred tax liability, and you'll watch it reverse as we work our way through the rest of this problem. But right now we're going to post to the deferred tax liability $19.2 million. I'll make one other comment here, and this isn't in the problem, but it's really important as we try to learn the concepts of accounting for income taxes, and that is, where does this thing show up on the balance sheet? So at the end of 2016, we have a $19.2 million deferred tax liability, and logic would tell you it would, show up as a liability, and you have to determine whether it's current or non-current. You would say, well, it depends on when the thing reverses in the future, and you can see it doesn't start to reverse until 2018, which would mean this is non-current. However, the rules for the deferred tax liability and asset are such that this is not a liability. This actually shows up on the asset section of the balance sheet, which defies logic, but not really, because if you think about why do we have this deferred tax liability, we go back to the underlying asset or the underlying reason for why it exists, and that is because we have an asset that has a different depreciation method for book to tax purposes. So this would actually show up as an asset, a non-current asset, and because it's related to this piece of equipment or building or whatever it is that we've depreciated.